Hi everyone, this is Eric from Traders Helping Traders. We're going to take a look at a very effective yet very simple means of trailing a stop. Most traders don't have any difficulty getting into a trade. It's staying in a trade for any period of time that gives most of us fits. The whole idea behind trailing a stop, of course, is to take advantage of a trending market. And I do have to point out that this method works very well in a trending market, but it does not work so well in a ranging market. No stop will really keep you in a ranging market, and that's not really the idea anyways. Always bear in mind that the chief purpose of a stop loss order is to get you out of a trade where the market is not behaving the way that it should. You always want to have a stop in place. Never place an order without a stop. It is your insurance policy against getting wiped out by the market. I chose the December 75 corn chart here, and as you can see, in the latter part of July 1975 to the early part of August, corn made a little bit of a pennant formation. And since it's a pennant formation, we can either trade this market long or short. So we have buy and sell orders to capture the market move regardless of which direction it goes from here. The next day we can see that the market broke out to the top side, so we would have actually bought the market on a move higher. Our sell order would now become our stop loss order. The day after the breakout, the market moved a little bit higher still. Now the whole point of this stop loss placement is that we only move the stops when the market is actually moving in our direction. So in this particular instance, the market traded higher, so we can move our stop, and the placement for this particular strategy is to place the stop below the previous day's low. And we do that in an advancing market. In a declining market, we would do just the opposite, and we would place our stops above the previous day's high. So let's play this forward a little bit. Next day, the market moves higher still, and so we bring up our stop below the previous day's low. The next day, the market did not move higher, so we hold our stops where they are. The next day, the market again moves lower, so we continue to hold our stops. The next day, the market made a higher low, but did not make a higher high, so we continue to hold our stops. And here, the market traded higher, so we can bring our stop up. The market did not trade higher, so we hold our stops. This day, the market traded higher, but the previous day's low is actually higher than the current low, so we would use the current low to hide our stop. The day after, the market moved higher, but we're already at the previous day's low, so we hold our stop. Market trades lower, market trades lower, market trades higher, and again the previous day's low is higher than the current low, so we'll use the current low. The market trades higher. Our stop is already in the correct place, so we'll leave it where it is. The market trades higher. Once again, the previous day's low is higher than the current low, so we will use the current low to cover our trade. Market trades higher. Market trades lower. And again, this is an instance where we have a higher low, but we don't have a higher high. So we hold our stops where they are. Market trades higher, so we can bring our stop up a bit. Market trades higher. Once again, the previous day's low is higher than the current low, so we're going to use the current low to cover the trade. And here we finally get stopped out of our position. So you can see that was pretty effective for keeping us in this market for at least a couple 3 weeks before we finally got stopped out. We managed to ride out a couple of the pullback phases before the market finally tagged us. So paper trade it. I think you'll find it a very simple and effective means to trail your stops, and hopefully it will lead you to higher profits.